Derek.
Yes.
I wonder if we could start with you. And we've heard from Vivek about how ESG is a cancer, about how it sucks the lifeblood out of the corporate world, it sucks the lifeblood out of democracy, sucks the lifeblood out of governance as a whole. Now, your organization uses a hashtag ESG scam. So that's taking it even a little further. So I wonder if you could just tell us a little bit about what your problem is with ESG.
Well, we're calling it what it is. We do believe it is a scam. Anything that takes other people's capital and uses it to advance a political agenda that person, by the way, has no say or even knowledge sometimes of, is in fact a scam. And so I represent an organization of 35 state officials from 28 states. Together, we represent $3 trillion of assets under management, many pension funds. And many of our states have just said enough is enough. The core economic engine for many of our states are some of the very things that the ESG movement is pushing against. I think the other thing that really makes it a scam is that the E and the S arguably have been a moving target, especially the S, where it's subjective. It's based on someone else's opinion of what ESG standards should be. There's no really great defined definition of the standard to which you should try to meet to achieve that ESG investing standard. So
you can't make something like that objective, right? You can't create tick boxes for it. People do.
No.
We created a tick box ESG culture where people will run through spreadsheets and tick boxes about what's going on, but you can't do that with something like
No, and our states have a lot of people don't realize, but in America, a lot of the state treasurers are the sole decision makers for banking contracts. Many of them sit on these pension boards. So last year, together, we decided to get BlackRock's attention, to get Vanguard's attention, State Street's attention. We led a divestment movement that divested $5 billion from BlackRock. This year, thanks to some of the legislation that's passed, we estimate we're probably in the neighborhood of 12 to 15 billion additional dollars this year. That has been moved away from some of these large asset managers. And we know that that's a drop in the bucket, but it's getting their attention.
Well, it did get their attention, right? And we hear significantly less from BlackRock now about ESG. So you've already had an effect.
Yes.
Yes.
And had stories written about us in the New York Times, and yeah.
So much so that Larry Fink no longer uses the phrase ESG.
Yeah.
He's stricken it from his vocabulary.
Conscientious capitalism, I think,
Conscientious
is the word of choice now.
Yeah. Terrence, let's hear from you briefly, because I think your view is similar, but maybe not quite so strident
in fact,
ESG.
it differs, Merryn, in that whether we call it backdoor socialism or cultural Marxism, which is what we heard from Oz Guinness this morning, I look at it from much more of a financial perspective. So, in fact, ESG has amounted to the greatest misallocation of financial assets in history relative to its intent. Just so people have these statistics, $120 trillion worth of assets are signatories to the UN Principles for Responsible Investment. And Bloomberg, your shop, not Financial Times, estimates that there's $45 trillion worth of ESG, socially responsible and sustainable investments outstanding. The very sad fact of the matter is that those assets were intended to do well and to do good. That is to say, to generate good returns while simultaneously solving the great social and environmental problems of our day, are doing neither. In actual fact, they are doing a lot more destruction than they are doing instruction, and that is because they are based on divestment rather than investment.
They're not all based on that. And we heard a lot
Correct.
during the great ESG bubble about how we could invest in ESG funds and we would make more money than if we invested in other types of funds, and perhaps that's turned out to be a function of low interest rates, apart from anything else, and their losses are a function of changing interest rates.
Yeah, in actual fact, Merryn, if we actually were to look at those asset classes that are doing well and doing good, very few of them are on public equity front. But impact investors, and I always like to cite the largest impact investor in the world, Sorensen Impact Center in Salt Lake City, have a private equity portfolio that is focused strictly on serving the underserved, strictly on promoting the United Nations Sustainable Development Goals, and has annualized returns of 54% per annum. 54% per annum. To the financial minds in the audience, I'm sure that's a stunning statistic.
Terrence, can I ask you, before we move any further, to explain what you mean by impact investing, what the difference is between ESG and impact?
So impact investors are actually looking for some type of verifiable environmental or social goal. Perhaps it's homelessness, perhaps it's recidivism, perhaps it's promoting gender or racial equity in economic opportunities, or, for example, low-income housing. So it's an investment that has a very genuine purpose, that is social or environmental, lower greenhouse gases, a very specific impact investment purpose that has to be measured tangibly.
Okay, but isn't that still using other people's money for a social purpose that they may not have consented
right,
to?
Not when it's done rightly, and where, in fact, people sign up, whether it's for concessionary or non-concessionary returns. I've written a book on it. It would be easy to just sell a book. So.
Okay. Helena, perhaps you could tell us a little bit about the 30% Club and what that means to you in terms of, well, really it's about the G, isn't it, what you're doing?
It is, yeah, and I think Vivek was quite right to call out E, S, and G should be, separate. So the 30% Club, the catalyst for that was the financial crisis of 07-08 that we've already heard about from Paul and Vivek. And the motivation behind it was to try to address the fact that we'd seen the most egregious example of the risks around groupthink. So at the time in the UK, more than 90% of board members on our top 350 listed company boards were men. They were all pretty much white. Many of them gone to the same school as each other. There was a very cozy club of people who were regarded as the right candidates for boards. So my thinking was, let's prise open the lid on that cozy club. And the obvious place to start was gender, just because women aren't a minority. And the reality is that we have achieved our goal, as you kindly said at the beginning. We went from less than 10% to now 40%, clearly exceeded my expectations, otherwise I'd have called it the 40% Club. But actually, I have to look back and I can be self-critical and say, actually, did we improve governance? And I think it's a very hard one to prove. There's no cause and effect, obvious link. But I look at some of the failures that we've seen in recent years. Obviously seen over the summer a big fiasco over Nigel Farage and being debanked, and the company NatWest explaining that was because it was at odds with their position as an inclusive organization without any sense of irony. We've seen Barclays now very much, the regulator has come down obviously on Jess Staley and said he can never serve in the financial markets again, and he's a big fine to pay. But where was the board during all of that? I mean, this has been going on for years. He literally was appointed in 2015 as CEO of Barclays, and the board at the time had 30% women, and we'd had stories in the Daily Mail about his links with Epstein then. So I have to say, have we actually changed the governance? Has it been more like cover for everything carrying on as before?
So it's felt like false progress. We've made a lot of progress on paper,
I think,
but we haven't seen the results from
where I'm coming from it. Obviously, I'm certainly not denigrating the impact on lots of women having more opportunity to serve, and I certainly think there's more appetite now for thinking, and I should have clarified, this is not about a quota. This is the opposite to a quota. This was saying, appoint people on merit, but let's broaden the definition of merit so that it's not just who you know, and it's, as I say, broadening the sources of people who serve on board. So that has been a good thing, I think. But the impact was supposed to be the boards would be more honest, better at spotting things, preempting things, and we would have fewer scandals, fewer corporate failures, less corruption.
Hasn't happened.
And so far, the jury's out, for sure.
Okay, so what would you do differently now?
So it's easy with hindsight, isn't it? Well, I don't know if it is. I mean, Paul already called out, as did Vivek, that actually shareholders need to use their vote more. But I actually think that we need to look again at what it is to be, how the boards should conduct themselves. I had the good fortune of serving most of my executive career at a company, a very small company really in the scheme of things today, set up by a guy who had built a whole investment philosophy based on the idea that no one has a monopoly on great ideas. I mean, Stuart Newton would never have known what a diversity initiative was if it hit him in the face. I mean, he never used those words. But he said to me at the time when I was, this is obviously many moons ago, I was a young woman, I was a mother, which is unusual in the city at the time. I'd gone to state school or public school, as you call it in America. I had studied philosophy at university. He said, bring all those differences to the table. He gave me a license to disagree. And I think from serving on board, sometimes I don't think board members now currently feel that they have a license to disagree. And so they just go along with things, and then we're back to where we started.
Okay, Terrence, I feel like you're wanting to step in there.
I'm also a philosophy major, so I just
well,
wanted
there you
to
Okay. Derek,
I think what is clear, and it should be a consensus on this panel, is that good governance is a sine qua non of excellence in capitalism. And thankfully, Helena has been leading that charge for some time.
Derek, can I ask you, clearly you don't want an ESG overlay as ESG stands on public investments and on pension investments, etc. But if not ESG, what? In that most people, if you ask them, most individual investors will say that they do want their investments to have some kind of overlay of long-term sustainability about them. So if it isn't ESG as we know it now, what is it that you think should change?
Well, most retirees and pensioners in America that we talk to simply want to be able to retire when they want to retire.
Okay, that's their version of sustainability.
And that requires fiduciary duty on part of the board of trustees that are managing it, the asset managers. It impels these boards and these elected officials to do their fiduciary duty, to manage the money to bring the best return possible. And I'm not advocating, and neither are any of our state officials, for a conservative political method to be brought into ESG to counteract. We just don't want politics in our pension funds, in our public funds. Now, I agree with Terrence. If somebody wants to invest their private dollars in a way that's socially impactful, we have no bones with that. I think it is just, you're talking about millions of Americans who rely on these, and the returns may not be as good when there's a great example. CalPERS has divested of every kind of fossil fuel over the last several years. If you've not been in fossil fuels for the last 24 months, you've missed out on huge returns.
Yeah, and you're also, as we were discussing earlier, if you've not invested in fossil fuels, you're kind of ignoring the S in ESG, because fossil fuels are, of course, one of the both great drivers of people's living standards.
Right.
Yeah, so it's the whole thing, something of a red herring.
We, in the really what's helped, I think, our movement grow is our effort to educate Americans on what ESG is, how we think it's being used. We started a campaign called Our Money, Our Values. That's a website, ourmoneyourvalues.com. We've had 50 million Americans that have joined the campaign, and we've seen on the retail side investors going to their financial advisors, wealth management advisors, and saying, tell me if I'm investing unknowingly in an ESG-centric fund, and if so, I want out. I want to know what alternatives are. We were really grateful to see companies like Vanguard renounce their membership with the Global Financial Alliance for Net Zero this last December.
Okay, so you can return power to the individual like this?
Say that again?
You can return the power to the individual like this by having them interact, understand what's going on, interact with their financial advisors, and ask for something different. That's the way out.
Yeah, absolutely.
So I just wanted to pick up on something that Derek said, which was about not having boardrooms politicized. And obviously we've seen examples here where suddenly mayonnaise becomes a political issue, apparently, when I think it has a good social purpose. We just like putting it in our sandwiches or whatever. But actually, what I don't want people to take from that, and I think it's a very important message from this conference, is I don't think it's right that everyone is silenced on all the principles of the day, on all the issues that really matter. There's a lot of evidence that suggests that most members of the public want CEOs, their CEO, to step up and stand up for worker rights, for reskilling of employees, to really kind of fight the corner when it comes to the wealth gap. I think what we've had is a bit of a false dawn with S and ESG in particular, and perhaps the E as well, being very much seen as kind of, a very subjective, use the words you used earlier, woke capitalism. But that's different from being a principled human being and being prepared to be courageous for things that matter and to set the context right for the businesses, all businesses in which we operate. So I just want people to not think this means business leaders should kind of go back in their box, never say a word, wait until they're spoken to before they say anything, because then we get a vacuum, and we don't get that triumvirate that we seem to be calling for here at this conference of political leadership, business leadership, and civil society all working together to improve things.
Okay, is that how you see it as well, Derek?
Well, I was very moved, as I think many people in the room were this morning, when Ayaan Hirsi Ali spoke about seed packets. And this is an optimistic forum, and our focus is on solutions. And I just want to point out that the United Nations Sustainable Development Goals, which is a helpful way of framing the challenges ahead, could be achieved by mobilizing $3.5 trillion worth of private capital in a mindful way. The impact investment community is prepared to start doing this. And it's only 1.6% of total assets that are outstanding. So the solutions, the gravest solutions to humanity's challenges over the next decades are really within our reach. We can solve these problems. I don't care if it's recidivism, homelessness, maternal health, infant mortality rates, literacy rates. All of these problems can be resolved, Merryn. We have the capital to do it. We live in the age of abundance. We have misallocated capital to ESG. We need to reallocate it to far more impactful strategies.
Okay, we've misallocated. Okay, that was a popular one. Obvious misallocation of capital with ESG.
Yeah.
So as far as you see it, the part of one's capital that is not impact simply has no ESG overlay of any kind, goes straight back to the ideas of Milton Friedman and is simply left to make as much money as possible and along the way automatically benefit all stakeholders.
And let me be clear, the pursuit of those profits and the pursuit of the use of the free markets is the very, very best way to generate those, including, where's Paul, through creative destructionism. We do need some creative destructionism in the world. That's how we, in fact, get rid of some of our most efficient companies. I would put Uber in the category of a creative destruction firm that has probably done more social good than evil.
Mm-hmm. Derek, you were saying earlier that you're certainly getting the attention of the big fund managers and you're getting some traction with what you're trying to do. But do you feel that we have reached a genuine turning point? I mean, the fact that we can sit here and discuss it, there are quite a few interesting books being written on the subject, and also, as mentioned earlier, that this great turning point in interest rates does change the way people perceive what we might now call old-fashioned ESG growth, etc. Do you feel like we're at a genuine turning point?
I think so, at least in the United States. I think we are. We've seen more than half of the states now introduce or pass anti-ESG legislation. We continue to see state divestments. There's lawsuits starting. There's a suit suing the city controller of New York for mismanagement of pension funds on behalf of police officers and firefighters and teachers. And I think that you're seeing more asset managers make public comments about, well, maybe ESG isn't the best investment option right now. And you're starting to see people back off from some of that. Terrence would probably be able to go into a lot more detail, but from our perspective, we feel like at least the brand ESG is damaged. And Larry Fink called it conscientious capitalism. I think it'll be interesting to see as we go in the future if it continues to be pushed but called something else at this point.
We say, with most of these political battles, it's all over except for the cussing and the fighting. ESG is officially dead. It has very few legs to stand on. Even the Financial Times is now publishing articles critical of ESG. That's another point to make. But broadly speaking, we are a hopeful assembly. We know that there are better ways. There are solutions. And those solutions are actually within our reach. That's really an important message I think we wanted to come out of this.
Yeah.
Okay, so for you, the key solution here is impact investing.
Pivot to impact. Not all assets. Most assets should be invested for profits only. But a small 1.6% of global assets funds the United Nations Sustainable Development Goals. I can get behind that.
Okay. Helena, for you, what's the way forward? What's the solution?
So I think it's actually healthy that the whole ESG movement is now sort of being, pulled apart and thought carefully, because clearly a lot of these concepts are very complex, very nuanced, and perhaps everyone charged headlong. I do think the combination of asset owners having more of a say, I think boards actually taking governance seriously, and I think there's been a lot of tick boxing, and that's where investors come back in and say, so what are you really doing? And I'd love to see even the people that they pick for the boards. I mean, it varies country to country. But in this country, certainly, there are a lot of people, you need experience and you need the ability to speak up when something's wrong. And I said, there's not a license to disagree at present, but we're also tending to choose people who've kind of had a quiet life. I went to a party a little while ago with people who were being singled out for having made a big impact on the City of London over the past quarter of a century. And frankly, we all agreed that none of us would get hired now because we all were too bolshy, to use a word that I think Paul uses about me. But we don't put our head down. We kind of have character. We speak up when we see something that's wrong. And we have to set that as the standard. And companies have kind of ended up hiding behind all these different layers of, this is what governance looks like. It's not about having hundreds of pages in a board deck. It's about people who really believe in something, as this conference is focused on.
Are you saying responsible citizenship?
I'm saying responsible citizenship. That's the answer.
But listen, how do you make the fund management community become responsible citizens like this? And one of the reasons why ESG has become so huge was because it has been a massive marketing opportunity for the fund management industry, one in which they can sell as being, or they have been able to sell as, do good, make money at the same time, and charge a higher fee on. And this has been, to my mind, pretty irresponsible. And how do you stop that business behaving like this?
So this is where everybody in this room can have an impact, because everybody in this room has a pension or is likely to have some savings that are invested. And you can demand more. You can ask your questions of your fund manager. At the moment, as we've said, and as our preceding speakers said, that money is it's your money that's being used at present, and a lot of people just have no idea that they can object to that, they can write in, they can ask for more. And if everybody does that, the alliance part is where that becomes powerful. So I think transferring this back to the end user, the beneficiary, the person whose money it is absolutely key here.
Yeah, and that feels like it's beginning to be underway, doesn't it?
Hold your fund manager to account. Just don't say, oh, well, I'll pay you all these fees and I'll accept what performance I'm given and you can vote on my behalf. I mean, no, enough's enough.
I always say, write to your fund manager. Send him a letter.
Everyone's going to hate me in the industry.
Proper letter. And for you, it's about people interacting again with their IFA, with their fund manager and telling them directly. But of course, a huge part of the population are never going to do that. There's always going to be an awful lot of investors.
In America, they are going to the financial advisors and they're asking some very, very wise questions about the types of funds they're getting invested in. We're seeing the impact. Some of these ESG funds are closing. They're no longer spending money to market them because they know that people are pulling out of them. So for me, fiduciary duty rules, capitalism works. Paul Marshall made the comment about capitalism solving some of the world's issues. The Heritage Foundation in the United States has a great study that shows the top 50 cleanest nations in the world also happen to be the 50th free market nations in the world. So you can't argue with some of that information and data that capitalism can solve some of the biggest issues that we're dealing with in our society.
But we still have a reputation problem, don't we? And that the ordinary person still thinks of the big company as being a force for evil rather than a force for good. So we have a branding problem. Terrence, can you see any way to fix that branding problem?
You know what I would say, Merryn, and we heard again eloquently this morning that freedom is merely the opportunity to do what we ought to do. And I would say that it's very clear to me that mindfulness, whether or not it's in the way we allocate our assets, how we choose an asset manager, how we govern, is going to determine really the future arc. I know the arc of history bends towards justice, but we can bend it even more with greater mindfulness. We're going to get the world we deserve either in this life or the next. And my belief is that we should be focusing on this world.
All right. Let me ask you all just before we finish, because we're out of time, in one word, 2 words possibly. What makes a good company? Is it the E, the S, or the G?
Is that our entire choice?
It's the G. It's the G is the answer.
Yeah, G.
Only that with the G.
There's no good corporation without great G.
Perfect.
Yeah.
Thank you very much. So thank you very much to my panel, and we will now hand back for the next session.